Well, we're value investors at Icon. We measure the market right now to be about 5% below our estimate of fair value. So we think we're in a healthy recovery, and we would expect the market to move higher over the next year.
All right, 5% below fair value, Craig. It's not like you're saying, this is the middle of the fourth quarter, we're off 20%. Remember you said, to buy on December 26th, and that was a good time. So this is one of those you kind of just own it and don't pay too much attention?
Well, our value readings then were much juicier, as you said. We measured the market about 15% below fair value. But the fears that were in place then, primarily 3 of them, they are subsiding. And as those fears subside, the market's simply recovering and moving back higher.
We had a guest or a Stifel data point yesterday who said we're already overbought in a number of different parts of the market. Do you agree with that? Are there places like the financials or some of the insurers that were at all-time highs yesterday that you think have come too far too fast, Craig?
Well, as value investors, we can find attractive stocks pretty easily in this setting. We do like financials, but also industrials, even information technology. We can find good bargains.
And Dom, those are some of the areas, IT, even the industrials, Boeing over 400 today at an all-time high that have done surprisingly well.
Yeah, I mean, there have been numbers of stocks that have been on shopping lists for investors out there. And they've done so because they found that the valuations for those stocks had been so depressed after Christmas Eve that they felt compelled, maybe not to go career long them, but to just nibble at them. I would say this, everybody's got their own determination for what fair value is, Craig included. But from a forward earnings perspective, valuation perspective, at the highs of the market last year, we were trading around, say, 19 times forward earnings.
That's high.
You're right. 2 to 3 months later, during that huge dip in December, we were trading at closer to 14 times forward earnings, and we're kind of in the middle, 16 times right now. So if you are looking for that reason to go long the market, that is the reason why, but it doesn't scream compelling like it did back in the early part of January.
Right, we're not that cheap. But Craig, what about those who say the Federal Reserve's pause means that there's going to be a higher multiple for equity markets? Is that something you can bank on, the fact that interest rates are so low and staying there?
I would agree with that assessment, but I wouldn't use the phrase bank on. We can't really predict how people will behave in the market. But without rates going any higher, it's real sensible to have PE ratios expand.